Buffett is worth over $100 billion. And the rules he built that fortune on, he learned from a book. A book you can buy for $15. That has been available since 1949, and most people have never read it. The book is called The Intelligent Investor by Benjamin Graham. Buffett read it at 19 years old. He called it the best book on investing ever written. He has called it that for over 70 years and has never changed his answer. This video is about the 5 rules inside that book that permanently changed how Buffett thinks about money. And I will tell you right now, Rule 5 is the most uncomfortable one, the one most people are not ready to hear, because it is not about the market. It is about you. Stay for that one. Before we get into the rules, let's settle something. Warren Buffett is not a genius in the way people think. He did not invent some secret formula. He did not have access to information nobody else had. He was not born with a special ability to predict markets. He was a 19-year-old who read the right book, understood 5 core ideas better than almost anyone alive, and then spent the next 70 years refusing to forget them. That is it. The rules exist. They are written down. They are available to everyone. The question is whether you are willing to actually use them. Let's go through all 5. Rule 1. The 3 most important words in investing. Margin of safety. Here is a question. When you shop on Amazon, do you pay full price? Almost certainly not. You wait for the sale, you check for coupons, you compare prices, you want to know you are getting a deal before you hand over your money. Now here is the follow-up question. When most people buy a stock, do they do any of that? No. They see a company they like, they see the price, and they buy it. Right now. At whatever price the market is currently asking. And this is exactly where most people get it wrong from the very beginning. Rule 1 from The Intelligent Investor is called the margin of safety, and Buffett has said it is the 3 most important words in all of investing. Here is what it means. Every investment has an intrinsic value, what it is actually worth based on its earnings, its assets, its future potential. And then there is the price the market is currently charging for it. Those 2 numbers are almost never the same. The margin of safety rule says this: only buy when the price is significantly below the intrinsic value. Buy at a discount. Give yourself a cushion. Because even if you are wrong about the valuation, the discount protects you. Buffett applied this rule when he bought Coca-Cola in 1988, when he bought American Express in the 1960s after a scandal had crushed the stock price. He waited. He calculated. He bought at a discount. He waited again. The market eventually caught up. It always does. Here is what this looks like for you. Stop asking, is this a good company? Start asking, is this a good company at this price? Those are 2 completely different questions, and only one of them leads to actually making money. The best investment in the world is still a bad investment if you overpay for it. Rule 2. The most useful fictional character in finance. Mr. Market is your servant, not your master. Benjamin Graham invented a character in The Intelligent Investor that Buffett has referenced more times than almost any other idea in his career. The character's name is Mr. Market. Here is how Graham describes him. Imagine you own a small business with a partner. Every single day, without fail, that partner shows up at your door and offers to buy your share of the business, or sell you his. Some days he is wildly optimistic. Business is incredible. The future is bright. He offers you an absurdly high price. Other days he is completely terrified. The economy is collapsing. Everything is doomed. He offers to sell you his share for almost nothing. His mood swings are dramatic. His prices are irrational. And he shows up every single day whether you want him to or not. That partner is the stock market. And this is where it gets interesting. Most people treat Mr. Market like an authority, like his daily price is a verdict on the value of their investment. When the price goes up, they feel smart. When it goes down, they panic. But Graham and Buffett see him completely differently. Mr. Market is not your authority, he is your opportunity. When he is panicking and prices collapse, that is when you buy. When he is euphoric and prices are inflated, that is when you wait or sell. You are not his employee. You do not have to accept his price. You just have to be patient enough to use his mood swings to your advantage. Mr. Market is basically that one friend who panics about everything. The one you have learned to do the complete opposite of whatever they suggest. Except in this case, doing the opposite of your panicking friend can make you genuinely wealthy over time. Here is what this means for you. The next time the market drops and everyone around you is selling in a panic, remember Mr. Market. He is not telling you something is broken. He is offering you a discount. The sale is not a warning sign. It is the opportunity. Do not let an emotional fictional character make your financial decisions. Rule 3. The two-sentence test that could save you a fortune. Know what you own and why you own it. Quick exercise. Pick any stock you currently own or have ever considered buying. Now explain, in 2 sentences or less, what that company does and exactly how it makes money. If you cannot do that, and be honest with yourself, you probably should not own it. This is Buffett's circle of competence, and it comes directly from the principles embedded throughout The Intelligent Investor. The rule is simple. Only invest in businesses you genuinely understand, not businesses you have heard of, not businesses someone on the internet told you were going to the moon. Businesses you actually understand, how they operate, how they compete, where their profits come from, what could go wrong. Buffett has famously stayed away from technology companies for most of his career, not because he thought they were bad businesses, but because he did not feel he understood them well enough to value them accurately. He stayed inside his circle. That kind of discipline is almost impossible to explain to someone watching a stock ticker go up on a screen. And here's the funny part. Research shows the average person spends more time choosing a restaurant for a Friday night dinner than they spend researching a stock they are about to put thousands of dollars into. 45 minutes reading Yelp reviews, 30 seconds reading a Reddit thread about a stock, then buying, and then being shocked when it does not work out. Understanding what you own is not optional. It is the foundation of every rule that follows it. Here is what this means for you. Before your next investment, write down 2 sentences. What does this company do? How does it make money? If you cannot write those 2 sentences with confidence, keep the cash and keep researching until you can. Confusion is not a starting point, it is a stop sign. Rule 4, the line that explains almost everything. Voting machine short-term, weighing machine long-term. This is the most quoted line from The Intelligent Investor, and it is worth understanding slowly. In the short term, the market is a voting machine. It counts who is popular, which stocks people are excited about, which sectors are trending, which companies are getting the most attention. Popularity drives the price, hype drives the price, fear drives the price. In the long term, the market is a weighing machine. It measures actual value, real earnings, real growth, real competitive advantage. Eventually, always eventually, price catches up to reality. The hype fades, the panic clears. What a business is actually worth determines what it actually trades for. Buffett built his entire career on this distinction. He is not trying to win the popularity contest. He is not trying to predict what Mr. Market will feel excited about next week. He is buying businesses with real weight, real value, and waiting for the weighing machine to do its job. This sounds simple. It is not easy. Because here is the honest truth about human beings and investing. Everyone describes themselves as a long-term investor. Everyone. Until the market drops 20% on a Tuesday. And then suddenly everyone is very interested in selling everything immediately and asking questions later. The voting machine is loud, it is emotional, it feels urgent. The weighing machine is quiet, it is patient. It does not care about Tuesday. Buffett has held some positions for decades, not because he was not paying attention, because he understood the difference between noise and weight. Here is what this means for you. The next time a stock you own drops and the news cycle turns negative, ask yourself one question. Has the actual value of this business changed, or has only the popularity changed? If the value is intact, Mr. Market is just having a bad week. Rule 5, the one nobody wants to hear. The investor's worst enemy is themselves. I told you Rule 5 was uncomfortable. Here it is. Benjamin Graham wrote in The Intelligent Investor that the investor's chief problem and worst enemy is likely to be himself. Not the market, not the economy, not inflation, not interest rates, not the Federal Reserve, himself. Buffett has echoed this more times than any other idea from the book. Because in 70 years of investing, he has watched brilliant people lose money not because the market was unfair, but because their own behavior destroyed them. Panic selling at the bottom, euphoric buying at the top, checking the portfolio so many times a day that every small move feels like a crisis, switching strategies every 6 months because the current one is not working fast enough, letting someone else's confidence become your decision. These are not market problems, they are behavior problems. And here is the part that makes this genuinely funny in the saddest possible way. Most people spend enormous amounts of energy trying to figure out how to beat the market, studying charts, reading predictions, following analysts, watching financial news for hours. When the actual challenge, the one that destroys most investment returns, is simply not doing something stupid when everyone around you is doing something stupid. That is it. The market has returned roughly 10% annually on average over the long run. Most individual investors significantly underperform that number, not because they picked the wrong stocks, because they could not get out of their own way. Write this one down. The Intelligent Investor is not primarily a book about markets. It is a book about behavior, about the gap between what the rational move is and what the emotional move feels like in the moment. Buffett understood this at 19. He has lived it for over 70 years. Here is what this means for you. Build a strategy. Write it down. Commit to it before the volatility comes, because it always comes. And when it does and every instinct tells you to react, go back to what you wrote down when you were calm. Your calm self is smarter than your panicked self, every single time. Here's the thing that connects all 5 rules. They are not really about stocks. They are about seeing clearly. The margin of safety is about seeing value without being fooled by price. Mr. Market is about seeing opportunity where others see danger. Circle of Competence is about seeing your own limitations honestly. Voting Machine versus Weighing Machine is about seeing time as an advantage, not a threat. And Rule 5, the hardest one, is about seeing yourself clearly enough to get out of your own way. Benjamin Graham wrote The Intelligent Investor in 1949. A 19-year-old named Warren Buffett read it and understood that the rules inside it were not temporary market strategies. They were a permanent way of seeing. 70 years later, $100 billion later, he still uses the same 5 ideas, not because he never found anything better, because nothing better exists. The book is $15. The rules are inside it. They have been there since 1949. The only question that has ever mattered is whether you are willing to think like an investor, or whether you would rather just feel like one. Thinking and feeling are not the same thing. Buffett chose thinking. Every single day for 70 years. That is the whole story.